Hello and welcome to The Pitch. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I am so excited to be back on this show. Just a couple of months ago, it was a special, just started out as a special, The Pitch. I joined Ellen McGonagle and Grayson Rose, and Dave Keller was the host of that show. And it was so popular that StockCharts has made it into a regular show now each month. So last month, in June, or last month in May, we had a second show, or really the premiere, I guess, technically. And now we've got a follow-up today, and I'm really excited to be here as the host today. This is an exclusive StockCharts TV show where we have 3 expert technicians, and they'll have an opportunity to come on here and pitch their best trading opportunities based on the current market environment. I think first what we'll do is we'll go ahead and bring in our guests. First, I'd like to introduce Greg Schnell. Greg is Chief Market Strategist at gregschnell.com. Greg, how are you doing today?
Hey, very good. Thanks, Tom.
It is so good to have you on here. I have a feeling we're probably going to head down the commodities road, but maybe not. I'll just let you get into all that. Next up, we've got Ellen McGonagle. Ellen is the founder of MEM Investment Research. Ellen, how are you today?
I'm doing well, thank you.
It is so good to have you on the show. And of course, You joined me a couple of months ago. And
I did. We were part of that inaugural show.
Yeah, I guess you did the best, though, because they invited you back.
I don't know. I think it might be my second chance. Maybe that's it.
There you go. And then finally, we've got Julius de Kempenaer. Julius is a senior technical analyst at StockCharts.com and creator of relative rotation graphs, or as many of you know it, the RRG charts. Julius, welcome to the show.
Thanks, Tom. It's good to be back with you in one show. It's been a while.
It has been a while, and it's probably getting a little late out where you are, I'm assuming.
7:15, so we're like 6 hours ahead of you and 9 hours ahead of the people in Seattle.
Okay. All right. Well, I'm glad that you sacrificed your dinner to be with us today.
My pleasure.
Yeah, just to go through some of the rules for those of you maybe that are tuning in for the first time to the pitch. Each of our 3 panelists are going to be ready and willing to provide 5 stock ideas based on the current state of the market. They'll each have 7 minutes to make their pitch for their 5 stock ideas. Later in the show, I'll have some specific follow-up questions to their presentation. And then during that Q&A session, we'll break into some more general questions for each of the panelists to answer. This is a crazy market environment that we have been in. I'm not sure which one was crazier, whether it was back when, Mary Ellen and I did that initial special presentation with Grayson and Dave, because we were right in the midst. We were just starting to bounce a little bit. I think it was back at the beginning of April. But then last month in May, of course, we had already had a pretty big rebound. And so what do you do there? I thought that was a really interesting show. And I'll tell you, I think we're at a really critical time here again now. We've seen the market, turning back over, volatility picking up. So I don't envy any of the 3 of you right now. But we're going to get this started. And Greg, you are going to be the first to pitch your 5 stock ideas. So let's get it started. Greg Schnell.
Okay, I want to start with the coming explosion in electric vehicles. And the reason I want to go down this road is I think there's a considerable opportunity building behind it. And I think we've all seen a chart of Tesla hit $1,000. And with that move up on Tesla, it continues. The stock obviously had a big run up, then a pullback and a run up. And this jump was on the discussion of starting working with the large semi-tractor trailers. And as we expand the requirements of electricity in vehicles, we still need charging stations to get that going. So here's our problem. Grids are not prepared for the demand. So roughly most grids in cities today operate near capacity. They definitely aren't set up for having a huge change, but copper volumes around the world will need to increase 5 to 10x in order to create enough copper for the wire, for transmissions, and for all the cars. So we have a lot of things going on, and environmental concerns stop the mines from being built. We also will have trouble approving transmission lines across country just due to the NIMBY thing, not in my backyard. So with that, we've got copper volumes for an electric car are 6 times the liquid energy, that being gasoline or diesel cars. And so looking at across this, we're going to see rapid requirements for copper growth. And governments are already starting to subsidize electricity rates so they don't get voted out of office. So some ideas on the backdrop, I want to cover that off today. So first of all, we need to find markets that are correlated with copper. And again, this is a bigger picture. This looks like it's starting to set up today as we roll out. And so I'm hopeful to see if this trend starts to break. So one of the big things here is we have the Australian dollar in an uptrend, we have copper in an uptrend, a downtrend, uptrend, and big downtrend. But one of the big things that happened was the Australian dollar broke out of a 9-year downtrend last week. And there is some horizontal resistance at $70 or at 70 here. But what we want to see is if this starts to break out, it wouldn't surprise me to find out that the currency is leading copper higher. And the Canadian dollar has the same sort of phenomena on the left and on the right. But the big thing we see here is I've used a best fit line. And if we go up to the, just touching the 2 tops, we only have another penny to go and we'd start to break out to the upside there as well. So the 2 major commodity countries that supply, that we can see publicly traded are both setting up to handle that well. So here's the US dollar, and what we see is a big uptrend here for 9 years, and it started to break down in the last couple of weeks, and I'm wondering if we're going to start to break through. So again, this is something that might take place over the next 3 months, but it looks like a big setup for me. So here's the US dollar zoomed in, and you can see we had a 2-year uptrend, and we're starting to break down. So all of this, you can see the PPO is about to go negative here, and if we want to watch what's going on, it's really important that we see all of these currencies start to line up with this trade. So here's the emerging market currency ETF, and it has underperformed like copper has for the same kind of period of time. So we'd also expect that emerging markets start to break out. This is the industrial metals index for the US, the Dow Jones US Industrial Metals, and it started to break out as we got into the final stages of the China trade deal. And then what happened is it broke down due to COVID, and now we've started to rebound, and we're right around the 40-week moving average. What I'd like to see here, obviously, is that this big trend finally does reverse. So I do think it was starting to break out, and then all of a sudden we had COVID slow the world down. So if this can hold, let's say, above the 10-week moving average and start to move back up, I think that's pretty bullish. This is the Goldman Sachs Commodity Index, and we had a false breakdown on this on the COVID news, and now we're coming back up, and if we can break out the top side of the channel, again, a lot of this started with the trade tariffs, and if we can start to get through this, this would be pretty powerful. So here's the Shanghai Composite. And what we see here is we're starting to build higher highs and higher lows. But what I really like is this downtrend in momentum is starting to break. And again, until we get above zero, it's questionable, but really want to see that starting to go as China buys over 50% of all the commodities. So here's 5 large caps to follow. And I want to use BHP. It looks like it's very close to breaking out here to new multi-year highs. And the momentum trend is about to break here right above zero. So that's very bullish. Looking at Rio Tinto, this one's sitting right on the edge of the breakout right now, and it is already broken through the downtrend. So I'd like to see that continue. Looking at Teck Resources, they supply a lot of metallurgical coal to China for smelting. And so this stock started to move in the last couple of weeks, and followers with GregSchnell.com we've been talking about a lot of the industrial metal companies breaking out. But this has a big 2-year downtrend that basically started when the trade tariffs started. So now we'd like to see that break to the upside. And here's Vale, which is a big company out of Brazil. So with all of those, I think this is one of the bigger opportunities. And again, here's Freeport-McMoRan. Obviously, Freeport-McMoRan Copper used to be the name, but we'd like to see this push above this big 2-year downtrend as well. So these charts are just starting to set up. It's not a tomorrow thing, but it's over the next little while. So I like to buy commodities near the lows to make big money because technology stocks are great for breakouts, but commodities range trade. So we want to try to buy them near their lows and then catch them on the way up. This sets up as one of the best obvious demand stories for the 2020s. And if you want to follow the progression of this trade over the next few years, if this theme and other investing themes fits with you, if you would like to find related stocks that are set to explode, visit my website, gregschnell.com. Thank you.
All right, very, very good presentation, Greg. I do have a couple questions for you, but I'm gonna hold off so that we can get through all the presentations first. So let's bring in Mary Ellen McGonagle. Mary Ellen, I know you were on here a couple months ago and had some great picks. I've followed them. I know Grayson had some great picks. I think I gave a few that were really good as well. No pressure, but you got to start at ground zero all over again.
Yeah, really. We're at a very, as you suggested, a very interesting juncture here in the broader markets. However, my background is always going to point me in one direction, and that is growth stocks. Putting up this slide to point out that I did for 15 years, I was with William O'Neill and Company, the founder of IBD, master of growth stocks. And during that time, I worked with top PMs and analysts, advising them on not only the broader markets, but on how to uncover, using the O'Neill methodology, these stocks that are really poised to greatly outperform the markets. So with that, I do have a historically proven fact. As many of you may know, Bill O'Neill did go back and do studies of the markets going back over 100 years, and there were commonalities among these big winners. One of the most prominent and important facts is that strong earnings are the primary driver of these outperforming big winning stocks. So bearing that in mind, let's take a look at a couple of stocks, and this first one is called Dexcom, DXCM. We're looking at a daily price chart. This company provides glucose monitors and other diabetic medical products. They're a key tool in managing diabetics. But what I did want to point out to you is a couple of items of interest here. One is the stock was a big winner going into the bear market. This is a big gap up in February. The company had 105% year-over-year quarterly earnings growth. They did drop certainly in line with the bear market, but they held support here at this 200-day simple moving average, and that only 4% of all stocks that traded did find support here. The other 96%, of course, fell well below this level. So that is certainly a sign of relative outperformance. The company did report earnings again in April. 980% year-over-year earnings growth. The company did talk about, similar to other medical drugs and products, there was a bit in the way of stockpiling going into COVID-19, but subsequent to that, the growth is real. They are seeing a lot of new patient additions. They also have the ability for patients to share their data directly with their physicians using their devices. So we can see that the stock powered to new highs here in late May, but take a look. More recently, it has pulled back, and to me, it's a very orderly pullback to this upward trending 50-day simple moving average. That's this red line. And more recently, prior to today's action, the stock was in the throes of reversing this near-term downtrend. This from peak to trough was about a 20% decline. So I would need to see a break of the price back up above these shorter term. The green is your 10-day, the purple is the 21-day. So a break back above these simple moving averages on any kind of volume would be quite constructive, married with a MACD crossing up above this black line up through the red. The RSI just popped down into negative territory today. But we can see it's done so in the past and has had an ability to recover from that. But I would keep this on your radar screen. It's also defensive in the sense that the products are still needed regardless of an economic slowdown. Next stock up is Facebook, well known. We can see that the stock prior to today was poised to break out of this nice 1-month base. But prior to that, Facebook did break out of this longer term 4-month base. They've also been big growers in the face of the lockdown. And most recently, we can see this big gap up here, huge volume, and that is on news. Facebook did announce they're launching a small business platform called Shops, and it has analysts really excited. It's in addition to a number of new products that Facebook has been adding to their product lineup. And we can also see here the company, this gap up, they reported 101% in year-over-year quarterly earnings growth. All of this upside action is taking place on above average volume, indicating that the stock is under accumulation. RSI and MACD are both positive. At this point, the stock is finding support at this 200-day simple moving average. And Facebook, Citibank actually has a $275 price target. The stock's currently trading at $226. Really, Facebook is the leader in their digital advertising capabilities. So there's a sense that this new Shops platform will seamlessly marry with their digital advertising to increase revenue and earnings. DocuSign is the next stock up, and we're looking at a daily chart. DocuSign controls about 70% of the e-signature market. It's been a really explosive growth area again during this lockdown period. The company uses cutting-edge artificial intelligence, really sophisticated algorithms, and it helps to automatically extract and analyze a lot of information so that clients not only can use their software to sign documents, they also have a new product called Agreement Cloud. So it has hundreds of pre-built integrations with Salesforce, Microsoft, and Google. And while DocuSign dominates the e-signature business, that total industry is nowhere near saturated. So analysts really have very constructive growth outlooks for this stock. We can see again big triple-digit earnings here back at the end of March, and then more recently the beginning of June, another solid quarter, 71% year-over-year earnings growth. RSI, MACD are positive. Stocks finding support at this upward trending 10-day simple moving average. Datadog, this is another software stock. They have cloud software that helps businesses monitor the performance of their databases, servers, networks, and so forth. Another big grower during this lockdown period, keeping companies connected and allowing them to oversee their data distribution during that period. Take a look at this gap up here on the daily price chart, 400% year-over-year earnings growth, huge volume. When you see a stock gapping up on earnings and it simultaneously breaks out of, in this case, a 3-month base, super bullish behavior. Stock is continuing to advance, finding support at this shorter term upward trending simple moving average. RSI and MACD are positive. Last up is somewhat of a defensive stock, Clorox CLX, but it also has experienced growth during this pandemic as their products really have been in high demand. Their bleach and disinfecting wipes. So the company announced that their factories will not be able to keep up with demand until the end of summer. We can see the stock is poised to break out of this base. RSI, MACD are both positive, and the company provides a 2.1% yield. They did on May 1st report earnings, 31% year-over-year earnings growth, 13% above estimates. So it does appear poised for further upside. They just signed up partnership with United Airlines to help disinfect their fleet of airplanes.
Excellent. Excellent 5 stocks. I also have some follow-up questions for you, but I'll hold on to them for just a couple minutes. And we're going to give Julius de Kempenaer an opportunity to present his 5 stocks. So Julius, welcome back. And you got 7 minutes. You're on the clock.
Yeah, thank you, Tom. Let me start the clock because that timing is a thing. My team is sector rotation, obviously, using RRGs as my weapon of choice. And what I want to discuss today is what I currently see going on the weekly time frame we're talking about is a rotation from staples and utilities into materials and discretionary stocks. And if you look at the RRG, then it looks like this. This is highlighting the 4 sectors that I just mentioned. And you see materials and discretionary traveling at what we call a positive RRG heading, inside or towards the leading quadrant. And we see staples and utilities traveling at a negative RRG heading, inside lagging, and probably after today, staples will also be inside the lagging quadrant. So that is my big picture framework. And what I did is I have picked 5 stocks out of these sectors, but I also like to pay attention to stocks that don't do well, that you should not own in your portfolio, or at least you should be very careful with. And that's based on a study that I did a long time ago, which basically the short version is that being underweight or not having specific stocks that go down is probably a higher added value to your portfolio than picking a handful of stocks that go up. And the first one that I want to discuss, and this is one that I think you should be avoiding, is Costco in the staple sector. And here is the weekly and the daily RRG of the sector, so the staple sector and the stock, versus SPY as the benchmark. And you see the rotation, that long rotation for both of these tails going towards the lagging quadrant. And if you zoom in on the daily, you will see that this staple sector as such is going through a small recovery, but Costco is not even able to keep up with that recovery. And if we switch to the chart, and here is the weekly chart, you see that that long-term trend here has ended, and we're now in a big consolidation triangle type formation. But what's more important, based on the RRG, and that's all based on relative strength, you see that Costco is coming very, very close to breaking that long-term trend line. And if I have to believe the RRG lines, they're already pointing down sharply. That's only a matter of time. And certainly if the stock breaks out of that big triangle formation to the downside, and here's the daily chart, and you'll see the early stages of rolling over and that relative strength going in a downtrend already happening. So Costco for me is one to avoid. The second one is an energy stock. That's a utility stock, NiSource. And the same story. Weekly, you see both traveling rapidly into the lagging quadrant, with NI taking over the sector. So NI is worse than the sector. And in the short-term recovery that's currently going on, you see that NI is not able to keep up with the sector itself. So it's negative on both time frames. If we go to the weekly chart, you see that this trend line here is broken. We found support at 2 previous support levels, one just above 19, the other one just above 21. We rallied, and that old support line started to act as resistance, and it looks as if we're putting in a new low. But look at that relative strength. That is a very clear break of horizontal support, with the RRG lines pointing sharply down below 100, putting NiSource well inside the lagging quadrant. And here's the daily chart, which basically emphasizes and enlarges what we've already seen there. We've touched that upper boundary, and we're on the way to the lower part, and the relative strength has just touched all support, now resistance. So NiSource is the second one that I think you should be very careful with. We then move on to the good stuff. Inside the materials sector, I've got 2 stocks for you to watch. That's Ecolab, ECL, and Newmont Mining, NEM. The weekly and the daily RRGs show the strength of materials, but both Ecolab and Newmont are far to the right. And the same goes on the daily. Ecolab has just turned. You see the sharp hook for Ecolab here. On the daily, that looks as a very orderly rotation. It's starting to pick up and overtake the materials sector. And NEM is a special one because it is very far to the right on the weekly, which means that it is a very strong relative trend. And it has just gone through a corrective move, a slowdown on the daily, but it's already picking up inside the lagging quadrant. So I'd like to combine those two. If we then go to the individual charts, you see Ecolab going through a very nice break to new all-time highs above 210. The relative strength line is pushing against that former high, and you see that the RS momentum line has put in a new low, and it's now starting to push the RS ratio line higher again. It is possible that we have to go through a small pullback here towards maybe the 210 to 15 area, but this could well be a very small flag in the making. I like the fact that we've broken out of this ascending triangle in relative strength, and here also the RRG lines are pointing to higher levels at short notice. So anything above 210 to 15, I think, is a good buying opportunity for Ecolab. Let's quickly move on to Newmont Corporation. That is similar chart as Ecolab, but a little bit further ahead of the game, I think. The breakouts are similar. It is respecting all support and resistance level very, very well. We see a strong breakout in relative strength that is causing the RRG lines to pick up. We're now sort of digesting that recent relative rally and coming off a little bit, but we've tested that 52.50 almost to the dot. And if we manage to stay above 52.50, I think that's a pretty good buy level for Newmont Corporation. And I need to do one more for you, and that's Lennar Corporation. And the weekly and the daily, this is a discretionary stock. The sector goes here. Lennar is way on the outside, moving ahead, picking up a lot of momentum. We're going through some short-term recovery, like the whole sector. The reason I've put in the equal weight sector is because we've had a situation where Amazon was driving the discretionary sector almost on its own, but it looks as if other discretionary stocks are now starting to pick up as well, which gives, I think, a little bit more breadth and more participation to the sector as a whole. If we look at the stock of Lennar, we had that big dip, and we rallied back above every imaginable resistance level possible. We're on our way to the 70 area, to these all-time highs. Relative strength is close to a resistance level and potentially going to break it. And what I really like here is this pennant-like formation that's taking place right now inside that rising channel. I'm going to assume that this is going to resolve to the upside, and Lennar is going to challenge that overhead resistance and push higher. And that was a little bit over my time, but I thank you very much for listening. Back to you, Tom.
That was an excellent presentation. And I find it interesting that you are the one to provide trades on both sides. So, which is kind of interesting with what's going on in the market right now, because there's a lot of folks out there that maybe think that this run to the upside's been too much. Is that how you would trade this market? I mean, just one quick follow-up question. Is that how you would trade this market, to take both sides?
Yes, I in my weekly show, Sector Spotlight, on a regular basis, I go over pair trade ideas or long baskets and short baskets. And the most important reason is what I already tried to highlight in my presentation, is that when I was working on the sell side as a professional analyst, I had an intern going over a lot of recommendations, and it's a pretty long story. It's a cool story, but it's too long for now. But the short version of the story is that what he found out is that there is, in general, much more alpha to be captured by not owning something than there is by owning something specific. And that goes completely against the nature of, I think, people in general, but definitely against the nature of professional portfolio managers, because they're always looking, what should I buy? And since that study, I always tell these people, you're asking me the wrong question. You should ask me, what should I not buy?
Exactly. All right. Well, I'm going to come back because I do have some follow-up questions for you, but I want to first switch back over to Greg, and I'm going to show a chart up here, Greg, and maybe to help illustrate your point a little bit, because I completely agree with you. I think you showed a chart of the XAD, which is the Australian dollar.
Yep.
You were also showing the copper chart. And so the only thing I did is I added this correlation. I don't know if we've got viewers maybe who aren't aware of the correlation indicator or correlation coefficient indicator. But this is just simply another tool at StockCharts where you can look at two different assets, asset classes, securities, ETFs, whatever, and just get a sense of how well, whether they're positively correlated or whether they're inversely or negatively correlated. And I think it's pretty interesting looking back over the last 10 years that you raise a great point that if the Australian dollar is doing something, or you're seeing that maybe it's about to do something, that it's pretty reasonable to assume that the copper is going to follow suit, I think, based on this chart. So I guess my first question is, do you use the correlation coefficient? I know you write a lot of blogs here at StockCharts, and I was just wondering if you've used this to kind of highlight some of these relationships that you've identified.
I don't use it a lot because a big thing depends on your setting level. You've used 20 and that works pretty good, 20 week. I visually, just knowing the commodity markets a little bit more and the commodity related trades, I just over the years have kind of learned what breaks out together. So I'm and obviously living in Canada, I'm deeply interested in commodities because a large part of our currency movements are based on commodities. So all of those things add up to just watching for it. But the number one perspective that I think, I come from a background of oil and gas, but if there's going to be a dramatic move into the electric field, we really we have nowhere near enough grid capacity. So I think it's one of the most exciting trades I can imagine.
Okay. Second question here. I'm looking at the XAD up here, and we got up to about 70, which was about the high at the end of 2019. Does that play a role? I mean, I'm looking at, and I get this question all the time. I'm sure you do. I'm sure everyone does. That it's easy to buy, but at what point do you give up on a trade? So when I look at the XAD, is there a point? I mean, would you be concerned if we went back down below these moving averages? And this is a weekly chart, so it's the 20-week EMA, which is down below, and then I have a simple moving average for the 50-day. But is there something that you would be watching to say, hey, you know what, this isn't working, let's bail? What are your thoughts there?
Well, I want to see, so the currency helps, and that's one of the clues. I want to see the Shanghai market, which is the single biggest buyer of copper. I want to see that break out. And again, we've got the break on the PPO momentum. For me, that's a really big clue that things are starting to change. And there's a good example. Look at how highly correlated copper pricing is to the Shanghai.
Yeah.
In the last 5 years, it's never been negative. So huge comparison there. And the main thing that I'm looking for, obviously, China's started the COVID started in China, but it will probably more likely end there sooner than the rest of the world. And so if they can get their manufacturing back on board, this is a real nice springboard.
All right. One last question for you. I saw when you pulled up the FCX chart, and again, this is one of those, when I was looking at it, I look at the market and charts a little bit different. I know you like to use the PPO and look at, or maybe it's the MACD, but you look at the momentum change, and clearly you can see the FCX trade here moving back up above its trigger line, starting to turn higher. When I look at it, I see this price support area, which it was able to negotiate along with the moving average, went through the 50, and now you got the 20 moving up, toward that 50. Again, looking at this price chart, because I think you were looking at it more from a trend line perspective. Would you be looking to get in this trade now, or are you simply waiting for the breakout of the trend line? What are your thoughts about getting in?
If I see BHP and Rio Tinto break out, like if they complete their breakouts, FCX, Tech, Vale will follow. And then I'm actually going to probably move into a whole bunch more aggressive small caps in the copper space, in the rare earths metal space, and all of that to follow this big momentum trade, because along with copper will be a lot of batteries, a lot of steel for transmission towers and new hydro generation or power generation facilities. So I'm expecting a big infrastructure growth curve across the space. There will be a lot of action in the utility companies alone. It's really a broad, wide trade that we have lots of things to look at. But the first thing should start to be that BHP and Rio, as close neighbors to China, are one of the biggest areas to look for that broadening support to start to kick in.
All right, and one of your, your main argument at the beginning was the electric vehicles. This was going to help drive the demand and all. That, I believe most people think is a long-term kind of a theme, electric vehicles. Do you see this as a long-term kind of a trade?
Oh, yeah. We've been in a commodity pullback since 2011. If all of a sudden commodities start to break out here, this is more of a try not to get shaken out and try to get in near the lows. And if we start to break higher, I think you could play a lot of golf and watch 9 years of success start to roll your way. So
I'm in. You just sold me. I've got a trading strategy where I can play golf. I know that's going to work. All right. Really appreciate it. Thank you, Greg. All right, let's move on to Mary Ellen. I had a couple questions on, from your presentation, Mary Ellen. I know one thing you mentioned is you like growth stocks, and you are literally barking up the right tree here with me.
I know it.
I'm a growth stock fan.
You bet.
And I maybe shedding a little light on a question I have later for everyone, but with the Fed coming out yesterday and saying that interest rates are going to remain near zero for the next couple years, and also saying that GDP growth is going to, they expect it to rebound to 5%. I mean, that is an environment for growth stocks, in my opinion. But my question for you is, if you look at Datadog, for instance, and these stocks that you gave were all great looking charts, but they've run a lot. I mean, Datadog, if you look down to the bottom in March, was trading under $30. Now it's trading 76 and change. What's your strategy if you find these stocks and you don't catch them on a breakout? Like somebody's listening to the show right now and they're like, hey, I really liked Mary Ellen's presentation in these stocks. What would you suggest in terms of trying to enter these stocks that have been so wildly, moving to the upside and have been overbought in a market that a lot of people can't even understand why we're going higher? What's your strategy if you're looking at the stock and now you're trying to get in?
Yeah, that's a great question. For me, it's going to have everything to do with the broader markets, and that backdrop is going to override any other decision. So you can see when Datadog, they actually started to advance prior. The markets hit a bottom there at March 23rd. And that's when the stock started to advance. I would need to see the markets continue in an uptrend to keep me interested. But really, my first sign of any real caution would be a break below the shorter term simple moving average, the 10-day. And that wouldn't be an exit sign. It would be more of a cautionary yellow flag, if you will. And it would just be then the 21. And as you progress, once a stock breaks below that 50-day simple moving average, historical precedence tells me that there is statistically more downside possibilities. The possibility of more downside is much higher, particularly if a break is on heavy volume. But again, that market backdrop is going to be my guide as well. I was able to get a lot of people out of that markets into that February decline using just those, yeah.
All right. Well, I noticed, too, the other thing, and I'm running into this a lot personally, as I look at a lot of these growth stocks, and you can see it here with Datadog as we keep moving up and putting in higher highs. And I know you use the MACD, so I went ahead and pulled the MACD up here.
Oh,
but
thanks.
the MACD is much lower.
Mm-hmm,
Does that bother you getting in or working into a position when you have a negative conversion?
Yeah, this is where it's really helpful either if an individual is really interested, but to go through a lot of charts, and I'm sure you do the same. I go through hundreds of charts regularly, and I want to see how this stock that I'm potentially going to own is doing relative to its peers. We have seen a deterioration in growth stocks over the last couple of weeks. They, by and large, have pulled back. We've seen the rotation into some of those newer financials, industrials, of course not today, but so that lagging is in line with other growth stocks with its peers. So it's not going to be as concerning to me as it would if other software stocks were really dynamically charging to new highs and this one was not participating. So really, and again, using the RRG will help you with that to stay on top of that rotation.
Okay. One other stock that you mentioned, DocuSign, is another software company. So you had 5 stocks and you picked 2 software companies. When you trade the market, do you consider, trying to be somewhat diversified, or you don't care if you like a chart and it happens to be that, 30% of them fall into the software space and that's what the market likes right now? Is that are you sticking with that, or how do you approach diversification when you look at these different stocks?
Yeah, so I'm going to look at I want to be where the leadership is. Technology came charging out in the beginning. And I talked about this when it first, actually our inaugural show, I talked about the concept that technology is defensive. It's a needed product. It's similar to consumer staples in the sense that to keep us connected, to keep the industries going, to keep children educated. We needed this technology. So I'm treating it like as it is a necessary, essential part of the market. And as such, I will go to where the leadership is within tech, and software is where it is. I'm probably not answering your question, but I will diversify, but it will be, again, with an eye toward leadership. Semiconductors is another area within technology. So among my suggested holdings list on my weekly MEM Edge report, it is right now has a heavy tilt into tech, as that's where the leadership is. But I do always suggest to diversify because the markets are always going to ebb and flow. Put in some of those biotechs.
Yep. Yeah, I like the approach that you take. I mean, I agree. I mean, when technology is working, when you've got other areas of the market or various industry groups within a sector that's working. I mean, if I want to outperform the S&P 500, the first step is to find stocks that are outperforming the S&P 500. Otherwise, it makes it very, very difficult. I don't try to catch bottoms, and I think based on your analysis and the stocks that you provide, you're not trying to catch bottoms either. You're going with what's working.
You bet.
Okay, let's move on, Julius. And Julius, I'm going to ask you maybe to, I'm always fascinated with RRG. And for the folks out there who've never seen RRG or maybe getting their first taste of it today, it is a great way to visualize the rotation. And, I know, Julius, you do a show here on StockCharts TV that talks a lot about that. But if you could walk someone through, I think you were showing the NiSource chart, NI, and how it was lagging its sector on your RRG charts. Would you mind pulling up your charts and showing folks how you set that up? I thought that was fascinating. Can you do that?
Yeah, I can grab the screen back for sure.
I mean, I can pull the chart up while you're getting things ready.
Yeah, that's not an issue. We're just gonna get out of the presentation and go into a StockCharts screen.
Yeah, I'm sorry to throw you on the spot, but this is pretty big. I thought this was cool the way you set that up.
What I actually did you can see what I did while you were talking, because you and Mary Ellen were talking about growth and value. And what I did, because if you don't know what RRG is, you certainly don't know that there is a drop-down box that has a number of predefined universes. And one of these universes is growth and value, and it's a small universe, but I look at it a lot for the same reasons you are doing it. And it basically looks at the Dow Jones Growth Index and the Dow Jones Value Index with the total market in the middle. And what you see here is that growth has been massively outperforming value over a long period of time. And as a quick reminder, stuff that's moving into the leading quadrant is positive. It has a positive relative trend versus the benchmark. So at this point in time, that's December 23, 2019, growth started to move into the leading space again, and value started to rotate the other way around, which is a pretty clear signal that you should prefer growth stocks over value from that point onward. And you see that that rotation continues. And we have now very recently started to roll over, but the primary measure is the RS ratio. So everything far to the right is strong, far to the left is weak. Well, you don't have to be a rocket scientist to see that growth is still strong and value is still weak, but it's going a little bit against it. And to zoom into that movement, I pull up the daily version of this chart, and then you see a similar thing. But interesting enough, you see the improvement of value over growth over the last few, well, what shall we say, few weeks. So here growth started to roll over and value started to pick up. That is the short-term counter move. And now you see that growth is inside lagging, but already starting to move higher, and value is still inside improving, but already started to roll over. So I am in the same camp as you and Mary Ellen with regard to growth stocks, and the slowdown that Mary Ellen talked about on these software companies. That's exactly what you see in this, let's say, higher level picture of growth and value. And I think that it's almost time. It looks as if that short-term rotation of value over growth is now coming to an end and starting to pick up again in favor of growth.
Would you need to wait, Julius, to see that growth turn back up and go above that 100 line, or do you think that this turn is enough information?
It's that's a $1 million question, Tom. I always tell people it completely depends on how aggressive you are. If you are a very aggressive trader, then obviously the long-term picture is still giving you. Let me put that on the side here. It's still giving you a pretty clear sign that growth is in favor of value, and the short-term picture here on the left is counter, but starts to roll up. I think if I would have given you, if I need to give you one like point in time trigger, it would be when the tail for growth turns into what we call a 0 to 90 degree heading. And let me see if I can quickly find a situation for you to show that to the people what that means. Go back here. So yeah, look at that. Look at growth. That the one is yellow now. This one is now traveling at, you have to imagine a compass around it. So it's now traveling at somewhere between 180 and 270 degrees. If we then scroll forward and we turn up, so we are now traveling at a heading between 270 and 360. Now what I would like to see is this. So from T-1 to T, you move into the 0, the top right quadrant, so the northeastern direction. That would be, it's not the way I trade and I look at things, but if I have to give people like one specific trigger, then this would be it. So here we are still below 360. We're like traveling at maybe 350. And the day after, we're traveling at 10 degrees, 15 degrees. So that would be, if you're really looking for a trigger, that would be it.
Okay. All right. Appreciate that. All right. Well, we've got just a few minutes left here. And so what I wanted to do was maybe do a quick question and answer with each of the three of you. And obviously the big news this week was the Fed coming out. I mean, the Fed came out yesterday and they said they're going to, they're looking to hold rates near 0 until 2023, which is more than a couple years. And they actually said that they're looking at a rebound in GDP to 5% in the US in 2021. So when I look at the chart of the TNX, this is just the last 5 days. But you can see at 2 o'clock when the announcement was made, we made this initial push to the upside in the Treasury yield back to about 0.8%. And since then, we have gone back down considerably, about 13 or 14 basis points, meaning that a lot of money is moving back into the treasuries and, of course, coming out of equities. So my question to all of you, maybe take about a minute each, but I'll start with Greg. When you, first of all, do you agree with the Fed? Do you think the Fed, is maybe smoking something? Or if you do agree with them, what kind of impact do you think that's going to have on the market as we go forward? In other words, do you think we've topped? Do you think we're going higher? What do you think, Greg?
Well, I still think we go higher. I think, when I go back and I look at any other QE periods, when the Fed has their foot on the gas pedal, and in this case, they've got their foot on a rocket ship, I fully expect the market to handle a lot of pressure. I mean, earnings have been abysmal or will be abysmal for the next quarter, and yet the markets have run up 40 and 50%. So I expect, literally every 6 weeks I mark a line on my chart what happened at the Fed meeting, and it could be a serious emphasis point in the short term. But when you go back and look at the QE periods where they threw money at the market, it stuck and the markets went higher almost unwavering. Like if you look at 2013, 2014, it was a super smooth trend back in time. So I just think the central banks worldwide have thrown so much liquidity at this particular event, and I realize there will be trouble with earnings, but when they're buying the high risk and they're buying the corporate debt directly, and they're through ETFs and whatever, I just think there's so much support for the market here that the downside risk has come off meaningfully by the government. So.
All right. I'm going to ask the same question of you, Mary Ellen. I mean, looking at, you're a growth stock fan, and if you talk about the Fed saying rates are going to stay near zero for a couple of, we're talking about 2.5 years, and GDP returning to 5%, do you think the bottom's in? I mean, you think that this is a market that's going higher?
Yeah, I am definitely constructive on the broader markets. When you look at what the Fed is doing, essentially they are really announcing and magnifying their support to do whatever it's going to take to right this ship. And that has everything to do with sentiment that then will spill over into the broader markets, which is always going to be that primary driver. So the Fed's actions, in essence, are big support, that they are willing to do whatever it takes to help. And that, I think, is going to go a really long way. This concept of keeping interest rates down, whether it is needed or not, will come to pass. That's what's going to play out. But I think the overall message is that they are here to help in any way. And that's really going to go, I think, a long way. Monetary policy, in just historically, is going to be your primary driver for the broader markets. When you go back with QE2 and all the liquidity that they put in after the 08-09 bear, really that was your driver for quite some time. So I think it's positive.
Yeah, I think too. I mean, you both raised some great points. I mean, when you look at the stock market, and I've always heard since I first started investing that the two things that really drives the stock market is our earnings and interest rates, that Fed policy. And there's no doubt that they're behind the market right here. But I'm going to get Julius's perspective on this to wrap up the show, because Julius, coming from Europe, I know that you've got a lot of stimulus over in Europe as well. But do you have any different opinions? And I'm even going to throw one more thing in there, because you picked a home builder. You picked Lennar as one of your 5 stocks. And when I look at this and I see, hey, interest rates going to stay low for the next 2 or 3 years, one of the first groups that pops out to me is home builders. It's like, this is like just drinking Kool-Aid from a fountain if interest rates are going to stay low. So first, your take on what this could mean to the markets. Do you think we go higher? And then maybe more specifically, what the Fed said and what that might mean for some of the home builders.
Well, you always do that to me, talking about the Fed and stuff. And you know that I sort of kind of don't pay attention to that, not really. So you're putting me on the spot. However, I'm going to give you an answer. I agree with you on, keeping those interest rates very low, that would be very good for home builders. And basically, I think the whole, housing industry and housing business The one thing that I like to look at when we talk about interest rates is not so much in terms of the absolute level of the yields or the bonds, but I try to put things into perspective. You can actually also do that with an RRG and look at how the yield curve moves, basically giving you a perspective on several segments of the yield curve, how they interact with each other. But coincidentally, literally today, I pulled up a chart of the 10 2-year spread in yields. And although the undertone of my talk today and my presentation and my calls were bullish, what I did see there gives me at least a little bit of reason to be worried. If you can pull that really up quick, really fast, it's $UST 10Y minus $UST 2Y.
It's right
and
here.
Make it really long. Make it like monthly over a long time.
This is 15 years monthly.
Make it longer. Go back, like put it at I don't know, whatever.
40 years.
Yeah, never how much data we've got. And make it a line chart. Yeah, exactly.
Okay.
Look at that. You see that. So when this line moves up, it is steepening, and when the line moves down, it's flattening. And I think that if you eyeball that chart very roughly, flattening is positive for markets and steepening is bad for markets. You cannot deny that we are at, below zero means an inverted yield curve.
Yeah.
Well, we had that like for a couple of hours back in 2019. But this thing is starting to give the first signs of, moving higher. So going forward, I am going, despite the fact that I love the low yields, and I think that it's going to provide fuel for the stock market, especially when the Fed says that they're going to keep it low for a couple of years more. I'm going to watch this spread, because if that starts to move up, that could be worrisome for the stock market as a whole.
Great point. Absolutely great point. Well, this whole show has kind of flown by, but not only are you three great technicians, but you're great friends. So it's been a pleasure doing this show with you. I want to thank you for taking your time to provide your ideas here on the show, also to respond to my questions. Sorry if I put you in any difficult spots. This is actually a really tough time for the market for sure. We've had so much emotion in this market, some panic followed by huge moves to the upside. Now we're rolling back over again. So there's a lot of emotion in here. But first, I just wanted to thank you all so much for taking your time to be here on the pitch today.
Thank you, Tom.
Oh, you're very welcome. All right, we're going to wrap up. Again, it was my privilege to come back here onto the pitch today to be the host. Really got a lot out of our three special guests, our three experts. I hope everyone enjoyed the show. And we'll be back in July with our next episode of The Pitch, so tune in. Everyone have a great day.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.